Welcome, everyone. Thank you for joining us at this HC Insider Podcast live event hosted by Onyx Group, Onyx Capital. We're talking today about the financialization of the oil markets and who really prices oil. A couple of housekeeping notes before I introduce the panel. We are going to be recording this for a podcast to be released in a couple of weeks or so. However, we'll turn the mics off for a Q&A after we're done with the main discussion. You'll also find on your seats, hopefully, a QR code to Slido. We will be asking a couple of survey questions throughout the episode to keep things moving along and sharing the results. And they're already up there, as you can see, which, we might as well walk off stage. But without further ado, my name is Paul Chapman. I'm the host of the HC Insider Podcast and managing partner of HC Group, a search and talent advisory firm in the commodities markets. Delighted to have Kurt Chapman, Director of LevMet, Greg Newman, founder and CEO of Onyx Capital, and also take a moment to mention author of The World of Oil Derivatives, available at all good bookstores. Tor Svelland, CEO and founder of Svelland Capital, Saad Rahim, Chief Economist of Trafigura, and Savvas Manousos, former head of trading at CESPA. So we'll get started. So I guess before we get on to the current state of financialization in the markets, maybe Kurt, you can give us a bit of an overview of how the markets have evolved over the last 10, 15 years and how we got to the current state.
Paul, thank you. I might even go back a little bit further than that. I started trading Brent in 1989 under the tutelage of Colin Bryce, who's kind of in the back row. And what's been interesting is I've tried to identify 3 or 4 circumstances or events that have led us from a purely physically traded commodity into the world that we are in today. And the first thing that I can think of is that you've had this massive complexity in the Brent market, and as it's evolved, there's been different elements that have been added to it. And the first thing that we had was it was a 15-day market, as some of you may recollect, just Brent and then Brent and Ninian. And in 2002, there was an expansion of the underlying Brent basket, and there was an extension of the maturity from a 15-day to a 21-day. And then ultimately, that was extended further in 2012 to 25 days, and in 2015 to month ahead or 30 days. And as you added that additional maturity to the benchmark, to the Brent complex, you added the need to understand what the curve was. And the curve primarily was the CFD curve, which was a dated curve. And so instead of just looking at the physical traded in that 15-day window, you had to look at the physical that was traded in a 30-day window and all the components of that curve that were associated with it. So you had dated as a CFD, a financial instrument that took on a disproportionate importance to the formulation of the price. The second thing, which may be a little bit more obvious, but quite significant, and I'll explain why, was the moving of the IPE, which became ICE, to an electronic contract, and then ultimately CME went to an electronic contract. So you can say to me, well, electronic, that sounds more financial in the first place. But what ICE did by going electronically in 2005 is it led to the Platts window moving in 2008 to the E window. So you were posting bids and offers, not just in financial instruments, not just in outright instruments, but also in physical instruments on an electronic platform. And so that allowed for the basis of the community to get more involved in Brent from a financial standpoint. The third thing, and I think the real kicker, was the global financial crisis in 08 and 09. And after 08 and 09, there was legislation, particularly in the US, Dodd-Frank, that insisted that not only that futures had to be cleared, but any kind of OTC swaps that different players were using, industry players, banks needed to be put into a depository so they could be monitored to make sure that they weren't being abused, to make sure there was additional systemic risk in the overall financial and commodities business. And then with 2012, both of the exchanges, ICE and NYMEX CME, started listing swaps as futures contracts. So before you could post a swap onto the exchange with a mechanism like EFS, now you could just trade them, and they would be, they would be there right in front of you. And this opened the world, or opened up the commodities world, the Brent world, to a lot of different other players. It was a space that was occupied by the major oil companies. It was a space occupied by the major trading companies. It was a space occupied by the major investment banks. And now, if you wanted to start trading whatever shop you were, you could get involved in these mechanisms. Not to say also that after the global financial crisis, interest rates went to zero and money was available. And then we saw a plethora of smaller financial players enter the market. One of them is sitting right next to me, originally at Mandara, and then started your own business at Onyx. DV Trading is another. And so you had this introduction of these players who started providing liquidity in these financial instruments that were having a dramatic impact on how the benchmarks were actually pricing itself. And I'm just looking at this thing right here saying what's more significant in modern trading, financial trade or physical trade. And what I can tell you right now is that the Brent benchmark, which is globally the most important oil benchmark and probably the most important commodities benchmark, is probably determined about 50% from a financial perspective, whether it's a dated curve or the outright price, and maybe 50% from a physical perspective, which is the differentials at which the different crude oils trade. Now you guys are saying, I'm stealing the thunder, 58% financial and 42 physical, but that doesn't surprise me. So we've gone completely from physical trade dominating to a more balanced scenario.
And I think we're going to talk about, thanks for that. Yeah. We're going to talk about what that means for the market. We're also going to talk about the different participants that are now in the space, and many of those are represented on this panel. So taking what's up there on the screen, which is quite significant, I think, and probably what we're about to debate. Greg, can you what does it mean for the market to be so financialized? How has that changed the nature of trading and indeed ultimately pricing of oil?
I think it makes Kurt a bit less happy to begin with. Pretty vocal.
Everybody has to adjust.
Yeah. Can we get up the slide on, so I think for me, this is where it starts, right? So everything Kurt's saying, obviously completely agree with. 2012, 2013, when they started to list all the swaps as futures on ICE exchange, but of course all the futures, I mean, it's just undeniable the growth. This is actually an internal study. And I've put this in my book, and it's 850% greater around now, but that's just on ICE. So this is everything. I think it includes Dalian even as well. And it's just been one way, a quite clear, obvious trend in both open interest and volume. And that's it. I mean, the first thing is it's just about influence. I mean, that's the whole point of this discussion. Paper trading 10 years ago was still comparable to the physical, and the physical hedging had a big influence. But as we've grown, obviously the paper influence is more. And what does that mean? What's the paper made up of? And as Kurt's saying, a lot of liquidity providers maybe, yes, but there's a lot of speculation, and the distribution between speculation and hedging is probably the key debate. Because if it's speculation, it can overwhelm any hedging, and it can just be a function of entirely whatever we want it to be. And I think that's where we are today, and a lot of it is collective sentiment. And that throws up how you analyze markets, how they're moved, and how do you influence and control it? This is what OPEC wanted to know about not so long ago. How do we evolve what we're doing into the financial markets? Trade houses have diminished influence, but still doing very well, of course. But it's not like it was. Everything's changed, and it's still it's going to continue to change, and it just needs adaptation and evolution. But I'll probably stop there. But yeah,
we'll do it like the presidential debate. I feel Saad, your name's been mentioned, so you get 30 minutes. 30 seconds.
Yeah. No, look, I think this is a great indicator of what has happened, and I think from where we sit, the introduction of new participants, it's good for liquidity, except now you've seen in the last couple, especially over the last year, where as positioning has dropped, it has created its own issues alongside that, right? And so there's positive benefits, there's negative benefits, or negative impacts on this as well. And you do get these feedback loops now, right? Where this increased financialization then says, okay, well, what is really the fair value of oil, right? And in a sense, and for us as physical traders, we're hedging, so we're not as exposed, obviously, to that outright price. But if you're then saying, well, we're expecting liquidity to be there, but at times where it's then not, because you get these cascading effects, like we saw that last year, we've continued to see that this year. Then it does change the market quite a bit, right? And the issue then really is also not just what's happening within this market, but something I always talk a lot about is, again, when you compare the value of, copper market, for example, value-wise about $8 to $10 billion a day, oil is 80 to 100 billion, and FX is $8 trillion a day. So, when big macro funds are allocating in or out of, their markets on FX, on rates, they can swamp, these other markets just given that volume at times, right? And so, again, coming back to what the actual physical market is telling you, how does that then, set against what's happening on the financial side?
Yeah. Greg, I think you've got another slide. There is a sort of argument now that it's flipped so much that now the financial market is almost dictating to the physical market how and when it should be managing its physical supplies. Is that a fair comment?
Yeah, I think that's what I really tried to tackle in my book. Like, I appreciate, things can still move logically, but when we talk about influence, physical versus derivative, you can actually define exactly what that is. We were just talking about it downstairs. Ultimately, the flat price, the month one, it's a function of the collective buying and selling. Whereas the physical is physical negotiated to the derivative. So it's only ever a differential. And that differential is held together through storage on the downside, and we were debating the upside, whether it's, rates or whatever it is, people switching grades or whatever else. But that means, in normal markets, you can really say it's about $2.50 to $5 per barrel influence on the price. And if we all collectively decide to sell Brent, even though the price is strong, it's the physical differential that has to adjust. And only on expiry and settlement will you get that push, that impact. So really the market's behaving logically is because people buy into the same things, supply and demand modeling, etc. But to Saad's point, where it goes badly is if everyone is talking about the same thing and you get a binary event, like obviously Russia-Ukraine crisis was bullish, we had very strong fundamental indicators, yet the market still sold off. That is purely a function of liquidity and positioning, and it's been one way. One thing I didn't mention just before, which I think might be worth adding, is when there's more paper volumes, and there's certainly more hedging volumes, you're actually bringing more cash money into the paper market. And that's quite an interesting thing to discuss because there's more money being made and lost on the paper now than there was ever before. And I think that trend will continue, and it kind of means that you kind of have to be in the paper market if you're a physical player now. Otherwise, you're essentially leaving some of the potential money on the table, or you can debate that. But that's something I thought I'd add. It's quite interesting.
Yeah, I was just going to elaborate a little bit also on the negative, what we saw over the last year was when we had these massive price spikes, and not just in oil, but across other commodities as well, right? But then you start to see the margin requirements go up, right? Which then results in actually fewer people participating. So then you get higher chance of another spike or a sharp drop. That again creates more volatility. That exacerbates the issue a little bit, and you saw that again cascade throughout these markets last year, right? So that's why part of the reason I would argue that the positioning is so low right now.
Yeah. Just before I want to come back to that, but Savvas, you've obviously built trading teams over the last 20 years or so. Like, how does that, the team you need to build today, the skill sets you need, and the sort of the types of tools you need to capture this positioning risk and so forth, I mean, that must be quite a dramatic change.
Yeah, I mean, if I kind of start back where Kurt was, I mean, when I started trading, an arbitrage would be open on the screen for 3 or 4 days. I mean, it was long enough to lock in both legs. It was long enough to lock in your freight. It was lock in to put everything in there. Now those things are there if they ever open at all, and if they do, it's for a few seconds or a minute at the most. And I think therefore the skills that you're building within a team are less about calling flat price, but more about calling sentiment, having the discipline for how you enter and exit positions, being really deliberate about how you scale in and scale out. The checks and balances you have from a positive perspective, because one of the things you always watch for is does a trader have the ability to come to the desk every day as if they were starting with a blank sheet of paper and say, are the positions that I've got on the ones that I would establish today, or are they the ones that I'm inheriting from where I had yesterday? And how do you stop yourself getting married to something just because it's what you're there? I think it's the holding period of futures and swaps now is so low in comparison to where it was, that the actual fundamental of looking at where stocks are because you're going to hold a position for 3 or 6 months, it's kind of not relevant so much, and therefore it is about where do I think the diff's going to go, or the particular spread over the next few days or the next week or so. And so it's a different type of trading. I think it's always with an eye to a fundamental of, is there a headline or is there something that's going to bring a shock? But actually it's about the management of money and position and the margin. And certainly if you're an asset company, if you're a refiner, you're buying a commodity typically to make $5 to $7 per barrel. Refining margin's been a bit more the last couple of years, but as a percentage of the commodity you're trading on very tiny margins, and therefore your ability to either completely blow that out of the water or get supernormal returns because you're calling flat price aren't really the risk game that you're in. So it's almost a team that looks at the fundamentals to say, am I bullish or bearish, but isn't trying to call where do I think the price is going to be next week.
Doesn't that make it even more important to hedge or to be transacting in paper?
Mm-hmm.
Because the margins are so small.
Yeah.
But that's what I was saying. So it's not necessarily financialization to blame. It's one-way positioning as well. So last year. So if you're not hedging and you're a producer, you're not providing the sell-side liquidity that would have been there. So you exacerbate these moves both on the up. And then when they come in, when the price sells off and people are stopping out, producers are effectively stopping out as well by rushing into hedge. So a lack of hedging is actually a bad thing. And you can't really blame financialization. It's more blaming the lack of activity by hedgers. And I think what's happening in the next 5 years, I guess we'll talk about it a bit more in a sec, but more trade houses joining, more people hedging is good for this, right? Good liquidity is what we want, two-sided liquidity.
But it's not just about hedging, right? It's about leverage, right? And the whole point about the financial market, and that's why the traditional trading houses who were involved in physical or in paper markets is because they can get more bang for their buck. Because there's only so much physical, and you see it in your last chart, which is how much more financial instrument liquidity there is relative to how many cargoes of Nigerian you can buy.
Can we put the survey back up just to see the results, and then Tor as the representative of the hedge funds here, is now 60%? Is that something you agree with? What's your take?
I would expect it to be even higher on the financial. If you look at who's participating on a daily basis particularly in the Brent market. So you start with the physical market, and then you have the really professional, which is Trafigura and the oil majors, etc. And they have their purpose of using the market. Then you have a kind of a layer with guys like us, the hedge fund, who trades flat price spreads, etc. Then you have the other products out there like the USO, you have ETFs, and they all have a quite huge impact on a daily basis on that particular flow. And then when this is derivatives on derivatives, and it's all leveraged. And that's what can cause these kind of massive moves. Like if you go back 2 years ago, we had like a drop from $82 to $66. Human traders won't create a 7 standard deviation move. But the financial world, like the CTAs and others, they can create it because they don't care. They find a trend and they trade it. So like as Saad was mentioning on the volatility that we had after the Russia-Ukraine. So if you use a VAR model with that volatility, and you stick to the VAR model, you have to reduce the position with literally 75%. Yeah. And that took out a lot of liquidity. And then it was a trend, and the trend follows was then, killing it.
Yeah.
So it's quite complex with how to read the market in today's market. You can follow the fiscal, but you kind of have to understand how it all works with all these players. Like USO, if they change the contract, which they do all, several times recently, but who has in this room read the contract on USO? Most likely, no one, except one of my team. Yeah. So it's getting quite complicated.
And you said actually offline that almost the scale of money coming in is too big for the oil markets. Let's stay, because can we put the second survey up, please? Because Savvas, you mentioned something interesting, which is essentially traders, for the most part, are talking about relative value, irrespective of the price. But a recruiter like me looks at the price of oil as does much of the world, and many contracts around the world are impacted by that flat price. Well, and there are obviously, outside of the physical. Well, let's talk about it. Saad, what's your response to this rapidly changing survey? And we should say for listeners in the future that right now traders are getting 70% and OPEC's only at 25%, but I think that's going to rapidly change. But Saad, maybe you can give us your take.
Well, I'm going to be a typical economist and say it depends. No, but it really, actually, I think it depends on your time frame, really, right? So you can see intraday what happens, right? And so many times it will be the dollar move, right, that drives flat price. Nothing has changed in the fundamental market. Nothing has changed in the physical market. Oil can be down $1, $2 just because of what's happened around rates, dollar, et cetera, right? So that has a particular impact. Over the longer term, though, fundamentals, I think, do matter right now. Do they matter more or not? It depends on the regime you're in. But again, if OPEC comes out and says, oh, we're cutting another 2 million barrels a day, that will have an influence on flat price, right? Or we're adding back the barrels. So it does depend. Interest rates is an interesting one because, again, it can have intraday impacts, but they can also have impacts over the longer term, cost of carry, but also eventually in the long run, in terms of new investments, cost of capital as well, right? So it's hard to say that it's any one of these things. And so again, that's why I would say it depends on kind of what time frame we're looking at. I would say traders, it depends again which traders, because I would say as physical traders we have no influence on Brent flat price, right? But if it's financial, then it seems to be that's where you can see moves being driven one way or the other in that sense. So I still think ultimately the fundamentals will tell, the fundamentals matter, but you can go through periods where there is the disconnect.
So physical traders have no impact on flat price?
Well, we just move oil around.
Yeah. Kurt?
When you look at the trade, I think the trade ceded the absolute price setting to the larger forces a long time ago. The macro hedge funds probably have much larger position, or you can comment on that than any of the physical trading shops or any of the banks. We look at things on a relative value basis. So it's this month versus the next month, or it's this month in Brent versus that month in Dubai or WTI. So I kind of agree that OPEC probably drives the price more than anybody else, and not only OPEC but the Saudis. But that's pretty pertinent right now when they've taken 1 million barrels a day off the market every month. So
yeah, Greg.
This is a bit facetious, but I think it always comes down to the traders in the sense that the price is the price. The Brent flat price is the price of the collective positioning. Your net risk capacity, how much can you buy, how much can you sell, it's going to gravitate to wherever the liquidity is balanced. And so that's what influences Brent flat price. However, undeniably, OPEC have a big say on sentiment. But again, we've seen this year so many interesting things. The market wasn't believing in OPEC at the beginning of the year, even though there was less supply. There was lots of things going on, and it was obviously a game of influence and a game of poker. And ultimately, OPEC have got themselves back into the driving seat. And it's fascinating. I didn't think they would be able to do it personally, but I think they showed how far they were willing to go, and I think it's very believable. And when you're getting these fundamental signals back again, you slowly brought some confidence back into the market to be long. And every stagnation we've had on the way up to what we are now, 80 to 94, 95, it made sense. People were worried about it being a risky thing being long because it wasn't working every time, and they weren't really believing that OPEC would have the main influence. But I think they're back in the driving seat again. So this is like every other game in town, advertising. It's all about influencers. This is the same thing. OPEC get very skilled at influencing. Myself and Saad, we were in Vienna. OPEC wanted to talk about financial markets more, and you debate it, and they want to know more. They want to evolve their strategy for influencing, and it's pretty. I can't deny they're pretty effective at it. So,
Tor, do CTAs care about marketing?
Yes. So I think that this year, we didn't manage to break at the 86, 88 level with several occasions, and we start sliding. But I think that the price setters this year, besides, of course, OPEC by cutting, has definitely been the macro funds. They have deep pockets, and they have a tendency to look at, from a historical point of view, how they trade. And since, many out there's been super bearish in China for the right or wrong reasons, I disagree, but that's besides the point. Then it's been this whole recession talk. It was an inflation to recession talk, and if you have recession, you should short Brent. And if you look at the curve back in 2008, it was a flat curve many years out at 140. This time, we have a steep backwardated curve, and you just can't compare it. But most people who made that call from the macro funds, they have not even looked at the curve back in 2008. So I think that's one of the reasons why we had quite massive shorts from the macro side. The CTAs, they found the trend, and they've been piling in. I read those reports very carefully, and we read quite a few of them. And at some stage during this, especially in Q2, I think they were almost maxed out on the short. So, and when they are constantly in the market, and you see that you can see kind of a disconnection between the euro dollar or the general dollar strength weakness, and on DAX and S&P, it trades just constantly bearish. And I think that ended up, being in charge of the market till we saw OPEC coming in and making the cut and took like a stand in the fiscal market. I'm not accepting this anymore, literally. That's what OPEC did. And they won because they were 94.
Because I was going to add, actually, what I should have said on the interest rates part, right, was if you look over the last 18 months, what has been the driver of oil price, actually, in a sense, has been the 210 spread, right? Because it is the proxy for recession fears, demand fears, growth angst, all the headlines that we see, even as we were seeing draws as we're seeing. So it didn't matter if you had Russia sanctions, price cap, Iran deal, no Iran deal, OPEC cuts. People were going, we're in a recession, we're going into a recession. Now that you've started to disinvert a little bit, now you can then also say, actually now where the OPEC fundamentals really are starting to tell. So it wasn't that people weren't believing the OPEC cuts, it was, well, they don't matter if we're going in for this inevitable recession. And yet here we are with the US growing 5-6% real maybe this quarter, right? So
it's complex though, isn't it? Because there's also, I'd be interested in this. Obviously we've seen a wave of assets come under management attached to commodities, the last 3 years, but with higher interest rates, with commodities, off their peaks and volatility down, are we seeing that money, I guess we come on to it, the fast money come out? And is that happening, and is that having an effect?
So the inflow to particularly the CTAs has been quite extreme because they did fairly well in 21, and then they had a stellar year in 22, and then got a lot of money into this year. And they're trading a lot of products, but their influence in the equity market I think is less. But they're so big that they have a huge influence in the commodity space. What is alu, copper, iron ore, and particularly Brent, and the partly in diesel as well. Just look at how could we be the biggest short interest in diesel just a few months ago. That was at the same level as March 2020 when we had a roll-down shutdown.
And that's trends.
Yeah, and that was the situation. And we were wondering, how who is willing to take this risk when we actually are running into a shortage of diesel? So what fascinating me as a human trader is that CTAs and others, they just look at numbers. They don't really understand how fragile we are on the supply side. I think that's potentially one of the reasons why they're trading the way they are.
Yeah. And Savvas, what's your take on who has the most influence on flat price?
I think I'm a little bit similar to Saad. I think it's over what period of time. I fundamentally believe that OPEC set. So I think the pecking order is the first that sets the price is the global economy. At the end of the day, oil only gets produced because it has to be refined into something because we need it for aviation and gasoline and diesel. If the demand for that ultimately isn't there, the demand for crude oil ultimately isn't there. So I think global economics set the sentiment in terms of demand. Second order then I think is the producers. And I think particularly OPEC. And even if you look over the last 10 years, you've had two great examples. I remember sitting in CERAWeek in 2014 when the Saudi oil minister, OPEC oil minister said, so if the US want a free market in terms of shale oil and right, we're turning on the taps and let's see where it goes. And you came down to $25 within 12 months. And you've seen the same more recently in terms of OPEC deciding that they're going to constrain it back up. Because I think if you break down the volume of futures that get traded, the actual percentage of the open interests that's held by people who care what the absolute price is relatively low. I mean, it's some of the funds, but even arguably some of the funds are just doing it from a diversification perspective because they have certain percentages of different commodities and different asset classes. They would prefer that if they had a long position it went up, but ultimately it's part of the overall consideration. Refiners don't really care because they're just doing it as a margin business. Most trading houses don't really care. Not many of them are trading absolute flat price. So the only people who ultimately are in it for where the flat price is, I think, are primarily OPEC. Even some of the big producers, Mexico, they're just doing it they're hedging to set a budget level. Do they influence where the price is next week and the volatility around that? No, probably not. But do they influence where the sentiment is and where the price will be over the next 12 to 18 months? Yeah, I think they, along with demand, it's just they have a lot more, they're a cartel of a lot fewer number of people that they can choke the demand, the supply side in a way that only a global recession could choke the demand side. So it's much more easy for them to have an immediate impact than the global economy.
Yeah. I mean, it does have a real world impact, right? I mean, if you think about the number of contracts around the world that are tied in some format to the flat price, and it's just sort of interesting that the people generating that are more bothered about relative value and so forth.
But Paul,
well, it's also quite interesting. I mean, you're talking about impact of things like the Dodd-Frank. I mean, certainly if you sit in the Western Hemisphere, it's actually very hard to trade flat price at scale, because if you're too successful at it, you're going to get yourself under review for were you squeezing a market one way or the other. So actually, there's a whole bunch of people who have no interest in and actually want to distance themselves from saying I had any outright influence on where the absolute price of oil was, whether it was to the upside or the downside.
I just think what we're not saying is the retail community, retail trading community, because financialization speaks to many more participants. And of course, individually, they're tiny. But cumulatively, like you're talking about the USO fund and ETFs, and it's just growing that. And they're fast money, and they do care about the outright price. And they're leveraged, like Kurt was saying. And I think if they all rush in because of one thing or another, like you're saying, a macro sentiment, they seem to have a very big impact. And I think that why I feel very strongly about this is because oil is the last one. FX does this, okay, that like Saad was saying, but what about, the cheap money leading to stock price rises, and we're getting like the GameStop squeeze. And these are all like very non-fundamental moves that are driven by retail traders. So as financialization grows, you're giving more power to the masses if the masses choose to trade. But it's even more, the argument to what you're saying, Savvas, is really interesting, because if there's so few people who care what the outright price is, then that gives even more power to the retail community who are speculating. And I think all of us, we all take more ownership over our investing now. And I think everyone, you were talking about your copper position, if you want to advertise that a bit.
Chairman told me to sell it today.
Yeah. So, we're all influencing the price by definition. And that's a super interesting part that I think will continue.
No, I think that gets...
We can hold that, because we're now going to talk about participants, and I continue that thread, because I think it is really interesting. Could we bring up the final, or the next survey? And this is pointing to that. Who do you most follow closely? Fund flows, physical traders, OPEC, inflation reports. And I guess talking about this juxtaposition of the physical market and the statements around that, but really these flows of money already moving. Greg, what's your take on the live results as they come in?
Yeah, I always thought we shouldn't have put OPEC in there, because I thought that's an obvious one. I think everyone has to follow. You can't ignore OPEC.
We'll discount
But
OPEC.
if we discount them...
No.
I should say for the listeners that OPEC and physical traders are battling it out at the top. Well,
I think it has to be fund flows, because at least if we're talking about Brent price, which is ultimately the outright price, the most influential on the outright price, because of exactly what we were just talking about. And a fund can be an ETF and retail if we pull that together. I think that's super interesting, apart from OPEC, of course. The physical traders, for me, you can only really use the CFTC report. And the shift and changing in those positions is rare. It happens every so often that it's big enough that you can say this is a material shift. So you have to follow it closely, but undeniably, like the micro shifts, assuming you're trading on a day-to-day basis, I think is all about fund flows, really. Fast money.
Just think that this is quite interesting. On the fiscal traders, I'm wondering how you're following the fiscal traders. I think that's very difficult.
We have to know by our research.
There you go. So, it's just to know what they're doing on the floors in BP, Shell, Exxon, etc., and Traf, Vitol, and Glencore. I think it's very, very hard. But, the fund flows, on the CTA reports, I think they're quite accurate. We've been able to trade around that information. And if you follow them closely on specific levels, it's literally down to the 88.87 kind of where they're triggering things. And we have seen this again and again. So I think that's, I'm a little bit surprised that fund flows is that low.
Kurt?
It's hard to say. I mean, I think it's been covered. Would you like to know what's going on in the physical market? How do you gather information in the physical market? You call up your counterparty, right? If you're a physical trader, you call up your counterparty who you're doing business with, and you say, what do you think about it? Margins look pretty good. A little less sour on the market, and again, people leverage those positions into the paper markets, right? So you get a kind of collective idea about what we traditionally call the industry view of the market. Now, it doesn't mean that they're always right. Usually, you get the best indication when you've just been to some of these meetings, like APEC, as you've probably been, and there's a collective consensus that kind of comes out of it about whether markets are tight or not.
Kurt, wouldn't you agree, though, when we're trading in the data Brent market, like you're saying, so you're trading, you're seeing what you're doing, you're seeing people that you're trading against, and it has such a big influence on the data Brent price, which therefore relates a little bit to Brent.
No, sure, and when it was purely an OTC market, you knew who the counterparties were. Now that it's less...
well, you can know trade
more
type.
Financial,
yeah.
But now that it's more financial, you can see what people are doing in the window because it's counterparty specific, but you don't necessarily see it if it's if it's a future, right? We used to look at the open interest by company.
Yeah.
Of what people would do both in the forward and the dated market to try to get an idea of just exactly what these CTA reports are, but for the industry.
So I would have been interested if this question had been asked 4 or 5 months ago, where inflation reports would have been.
Yeah.
Back when inflation was running super hot, I think, again, people were looking at that going, what's the impact on rates? What's the impact on the economy? What's the impact then on demand, right? I don't know if it would be the top one, but I would have said it would have been higher than 5% probably.
Yeah. Just, I guess, looking forward, how do you think this chart would look in I mean, it's a very hard question, I know, but in 5 years, I mean, I guess somewhat of your contention, Greg, is that actually as more and more, as the markets become more financialized, more retail money can come into the space, you know, you've got presumably even more sophisticated algorithms and money flows and so forth, and actually that is, you know, that has increasingly become a tidal wave that you can't hold back.
Essentially, so we look at the last slide, I guess, is what you're inferring, or?
Yes.
Yeah. If we can pull up the last slide. This was a really interesting study because obviously there's been a manic volatility 2020, 2022 as well. But if you get the standard deviations, average them out against the average prices for that year, and you do that across all products, and this is just swaps to be fair, but swaps are the main kind of, they financialize the most, right? More than futures, has been a huge boom. And again, it's completely inversely correlated. The more swap market volume, the less volatile. So it's an interesting discussion because someone was saying just before, you know, people blame financialization for volatility. And actually I talk about it in my book, even the CFTC chairman a long time ago was referencing the onion market and how they proved that before and after the financial market for onions got banned, it's more volatile than when there was a financial market. It really is, it really does look like that. So if we're going to a more stable market, a more financialized market, we'll probably have a more stable market and a more functioning market. So I think with many more, it seems like all the big majors out there who aren't in paper are going to be in paper either very soon or planning to be. And that should have a great stabilizing impact on all the contracts. And remember, there's 650 plus contracts that are very much related to the physical. And when you talk about mapping physical trade houses, I understand that's hard, but actually in the swap market, because the liquidity providers especially, that's what we do, right? We're taking the other side of all these guys, and therefore we have the data. And the other slide, if you guys can go back to it, the one with the counterparty types, you know, what this very clearly shows is that, you know, from our data, it's obvious that the majors and funds and banks, they trade a lot as a proportion down the forward curve, but when it gets to pricing, it's absolutely dominated, or much more dominated, by trade houses who, you know, ultimately hold the physical, and that's how you infer like what's really going on in the underlying fundamental market. And I think there's going to be a lot more of that. You know, people are going to be really thirsty for this data because it's really so important. And I think it's a good thing that you can get more and more financialized in the specific contracts that relate to physical, like the dated Brents. You know, you can come up with a contract for anything these days, and that if that gets liquid, then therefore everyone has more information about where things are. Like I don't know if many people trade Merben contracts these days, but at least it's a great figure to know where Merben versus Brent in, which was a big part of our market. You know, when's the Merben arb open? Because we think people are going to buy at 40s. Now that's really transparent. That's a huge advancement.
But I think the difference, and we talked about this, is when you look at those volatility numbers, and I was kind of surprised by it, and it is quite inversely correlated. You're looking at it from more of a differential basis. Because one of the things that nags me in the back of my mind is I say, so spring of 2020 and WTI goes negative. Why did that happen? Is that because of the GameStop phenomena? Is people were in the USO contract and they didn't roll, and they didn't understand that that there was a limited amount of storage on which the contract was based, and at no price would you buy oil. Now, we all know that oil should not be negative, but at that particular location, it was negative. And why was it negative? Because there were too many people getting into the market from a financial standpoint who didn't understand, again, the physical and know how the specific contract worked, and said, oh, I just want to go long oil, and this ETF's going to give me an opportunity to do so. So I take your point on the swaps market that we may be getting less volatility, but when you bring in more and more participants that have less and less knowledge about the underlying, are we getting less volatility on the absolute price? I don't know.
It's one of Trafigura's contentions or talking points, I guess, you know, your colleague Ben and so forth, that actually in the energy transition and the digitization, we talk about in the podcast a lot, energy transition, deglobalization, digitization, all creating volatility. Ben was saying, you know, that we expect to see more spikes more often, which I say somewhat, you know, goes against the idea that financialization is going to, you know, help. Well, hopefully financialization will support that, but I guess what's your take, Saad?
Yeah, no, that's the thesis we've had quite publicly for some time that I think we're moving away from a world of commodity cycles to one of spikes, right? And I think where we are in terms of shock absorbers that we used to have, whether it was inventories, whether it was spare capacity, refining capacity, your ability to turn on shale very quickly, you had all of these shock absorbers in the system, and you don't have those anymore, right? The SPR, look where that is. Maybe it's not as important anymore, but all these things add up. And it's similar across a lot of these commodities, right? We can, copper, wherever else as well. But that lack of investment really now for a decade that we have seen, right, makes it hard to then see how we don't end up in some of these spikes. And if you believe, the projections for Q4 of this year, a couple million barrels a day deficit, depending on who you look at, I mean, that adds up very quickly, right? And so you end up in these situations where, I think you get these spikes, and then that potentially gets exacerbated by people starting to chase that, right? Let's say tech has a bit of a wobble. All of a sudden, retail investors look around, hey, wait a minute, oil is at $100, or if it is, then maybe that's a magic number, and people say, well, let me get in there. And then what happens then, right? So.
Yeah. Well, we're sort of coming towards time and to do the Q&A. There's one final bit that we actually all discussed sitting around, was talking about the talent piece of this. And actually, that's quite a stark change, isn't it? You're talking 15 years ago, 10 years ago, very much being very schooled in the physical side of oil, and suddenly we're now talking about the financialization. It's a whole new series of lenses that are coming into play. How is that changing talent? And I assume, from our perspective as HC Group, the talent in the commodities world is relatively short, and not many new people are being made. I mean, it seems like that's also going to be another source of volatility with all these trading and producers and refiners wanting to build trading capabilities in a volatile world. I guess, Greg, maybe, or Tor, you want to...
Yeah, you're spot on. It was almost like embarrassing working for an oil company a few years back, so here we are. I think the whole, it's always been like a demand story in the commodity space. And for the first time in my career, since I started in 1989, it's actually a supply story. And I think we're going to have a lot of shocks. And when we have the shocks, then the politician and a lot of others and more money will be available. But this is going to be, we will have shocks the next 3 to 5 years. Yeah. And these shocks will probably be some kind of attention to the new generation, that the commodity market is actually quite cool.
Yeah. Well, in the interest of time, let's move to our last bonus question, which I think will point to this. You can't have the star-studded crowd on stage that we do without getting some take on where oil prices are going.
Oh. You mean December contract, or do you mean December?
Well,
calendar?
no, I mean, to be clear,
because that's 2 months early.
Yeah, because that's
December 31st, end of the year.
December 31st.
Okay, there we go. Just to be clear.
Just to be clear. Saad, this seems like you're...
Well, if it was December contract, I would go 90 to 100 easy, but December end year, I'm not so sure.
Anyone want to take a stab? Savvas?
I mean, I think it's a good example of why liquidity and volatility don't need to contradict. I mean, because I agree with Greg that more retail investors brings more liquidity to the market, but brings more stability. But I think it doesn't remove the fact that you can still get quite volatile shocks. And there, I think you potentially have a slightly different set of factors that play into some other markets in terms of the amount of margin call that you can get on a specific day can introduce volatility if you're forced to close your position. And you say we saw that in LNG last year. So I think you can get both things can actually coexist. That you can have a large amount of retail investors that on average dampens volatility and makes a more transparent market, but won't absent us from being exposed to specific events.
Yeah.
One piece, and I don't think we have the data to see it, but it would be interesting. I was kind of showing yesterday. There's an advert currently running on Bloomberg at the moment for an FX trading platform. And if you kind of watch the advert itself, it's all about how glamorous it is and how easy it is to make money and everything else. If you read the small print, it says 79.87% of retail investors lose money trading this platform. So I think there's on the one hand, if you're an institutional and a professional investor, more and more retail money coming into the market is a good thing.
Yeah. Yes. Yeah. More losers. Well, I should say for listeners, it's between 90 and 100 is just winning, with over $100 next. But thank you very much to the panel. I think it's been a really interesting discussion. Probably more questions than answers, but really interesting insight. So thank you very much. And then we'll kill the recording there so that people can ask what questions they like.